Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content here at Interactive Brokers, and today I'm your host for our podcast. Our guest is Jin Hennig, Managing Director and Global Head of Metals at CME Group. The mineral market involves many different areas in security, but what makes up the market? What are the pros and cons of investing in this market? We're going to explore all of those questions and more. Welcome to the program, Jin.
Thanks for having me, Cassidy.
Yeah, of course. So, since today we're going to be talking about a very hot topic, minerals, metals, everything associated with it. What is your background in the industry? Let's talk. You're the perfect guest. So I'm excited for everybody to hear your background.
Sure. So I've been involved in the commodities and financials markets for about 2 decades now, with a focus is specifically in metals. That includes both precious and industrial as well. I started my career actually in the physical industry before I joined the exchange. So I have a unique sort of experience that spans from the physical trading to financial markets. I've worked very closely with the corporates, the miners, the producers, all the way to manufacturers, then now moved to the exchange business. I interact regular basis with the financial industry, such as institutional investors, trading platforms, hedge funds. It gives me just a very much well-rounded perspective on how minerals markets function from ground up.
Yeah, that's great. Just to dive in here, most people initially, they're going to think that the minerals market is something that they can think of. I think like the earliest, most identifiable thing that most people come into contact with is they think, oh, silver and gold. That's very straightforward. But there's many other things. What exactly makes up the market in the securities area?
And Cassie, you're absolutely right. The mineral market is a broad ecosystem. I always joke with my kids and say anything that, comes out of the ground, the dirt, there's a lot of minerals that you see in the entire chemistry chart, right? Out there. But to your point, it includes precious metals like gold, silver, platinum, and palladium, which are often viewed as safe haven, store of value, inflation hedges. Then you got on the other side industrial metals, which actually acts a lot like just general industrial commodities, which is copper, aluminum, lithium, cobalt, steel, which are critical for manufacturing, infrastructure build, and nowadays increasingly technology like electric vehicle, AI, and renewable energy systems as well.
Yeah, I think the automated vehicles and electric vehicles, that's where you really start to hear a lot of these keywords when it comes to minerals and metal. But in my research, I noticed there was a lot of, we'll say, jargon associated with the actual market or the sub market of the larger financial area, which metals and minerals being major and junior groups. What exactly are those and what makes them different from each other?
So, in the mining world, the companies generally divide into major producers and junior miners. So, major producers, think of them as very large established firms with producing assets. They tend to be multinational by nature. We're talking the employees of hundreds of thousands of people, just because metals and mining in general hire a lot of employees. They tend to have a very diversified portfolio. So, it's not going to be just like a one minerals they produce, but multiple different ones with a more stable cash flow. So think of companies like BHP, Rio Tinto, Freeport-McMoRan. So that will be what you would consider as a major miners. And then you got juniors. Juniors are tends to be smaller, often on the exploration stage of the firms. They might be just in the production stage, or they might not even be in a producing stage yet, but exploring and developing new resources. They carry higher risk and obviously, but also has a potentially higher reward because of that. Especially if they make a significant discovery in that mine or get acquired by a major.
So, a lot of the elements associated with this, no pun intended, you can almost see them out in your life or interact with them on the daily. That a lot of people may initially look at this type of market or category and say, this totally makes sense because it's super crucial and it seems like a pretty good area to invest in. But what are the pros and cons associated with this investment area?
Sure. But before I go in there, Cassidy, let me just talk about some of the ways that you can have invest exposures in these markets. So number one, I would say maybe largely three categories. Number one is you can have a direct exposure through commodity futures contracts. So the good example would be CME gold, silver, copper, and aluminum. And we actually now have very much of a growing, budding battery linked contracts, such as a lithium and cobalt as well. The second way to think about it is you can have equity exposure via stocks, right? Ranging from, as we talked about earlier, large producers and juniors as well. But many times the challenge with that is that they tend to produce multiple different minerals and metals in that specific mine. And there are many other factors that goes into stock evaluation. So two companies might be in the same industry producing the same thing. Based on their evaluation, it could be hugely different based on how they operate. You might produce, and oftentimes you will see a mine that produces gold and copper as a byproduct at the same time, but the price movement of these two underlying products could massively different. So yes, you can expose yourself via stock, but there's many other risk factors that goes into it. And then the third is diversified option like mutual funds or ETF that focus on specific segment. One of the good example will be like energy transition metals index or precious metals index, where it would have a basket of different grouping of different underlying products as well. So I would say there are three different ways for you to think about how you get an exposure to some of these minerals and metals sector. But and obviously I would say the biggest benefit is you hear a lot on the news obviously lately. So potential for strong return, especially in the bull markets driven by supply and demand factors. And you hear this a lot in all segments of metals. In fact, if you think about it, gold has been the best performing assets this year. So you certainly see that a lot nowadays. That's a playing a factor. The second is diversification strategy, right? From your traditional asset classes like equities and bonds. So commodities tends to have a different correlation. So it's just another diversification strategy. Third would be hedging against inflations or currency devaluations. Commodity tends to hold its value. This is especially the case for precious metals such as gold and silver and platinum and palladium. Now, if you're thinking about what are the risk factors or cons around it, number one is high volatility. So price can swing sharply due to the macro factors or geopolitical events. Again, but also at the same time, that's what actually attracts and makes it interesting as an investment. As I talked about earlier with the stocks, there is just you get an exposure to many different things along with underlying commodities, such as operational risk. The third is environmental political risk, particularly in the regions where mining policies may shift unpredictably. And obviously, lately the biggest, the most commonly used word is tariff, and that certainly has impacted our metals market across the board. But in general, I think futures contract comes handy when you can handpick specific minerals or metals you want to have an exposure to and take other risk out of the picture. You can also have more leverage through futures contract where you're putting down only certain percentage of the underlying full value for that entire exposure. So I think there's a benefit of futures contract for being able to tailor specific exposure that you want to have, and also leverage aspects of it is much better in futures versus fully owning certain assets or fully buying gold bars and just hold on to it.
That's a really great point. We actually touched on that a little bit when I think it was in the past month that it was released, our podcast on gold, talking about the aspect that not a lot of people think about, which is storage when you have a tangible asset, things of that nature. What type of exposure can you actually handle, secure, hold, versus what do you want as your outcome based on your financial goals? There's a lot of things to consider. And in this area, it seems there is definitely a variety of different securities that allow you to get that exposure. We're going to dive a little bit deeper now because we laid the foundation for
Mhm.
our listeners if they're new to the financial sector, that is the metals. But what are some things to keep in mind when you are actively investing in the mineral based products? Because as most people can deduce, there's going to be areas with commodity prices fluctuating, correlations to other stock markets or variables. The geopolitical and environmental factors are huge. What are some initial things to keep in mind, or maybe like a short checklist to keep in mind when you're evaluating it as a potential for an integration into your financial strategy?
Great question, Cassidy. I think there's so many different factors that goes into different movements of the metals and underlying minerals, but I would say that it would categorize maybe three things to really think about before you're investing. Number one is commodity price fluctuations. A lot of these metals and minerals are heavily influenced by global economic activities, monetary policy, currency movement, tariff, for example. have and still impacting quite a bit. And Section 232, for example, is impacting our markets in steel, aluminum, copper. You hear this on the news all the time. So, just to think through many different factors of underlying price, commodity price fluctuation, I think is important factors. And another thing is just like in any investment, the duration of your investment is also important. The second is geopolitical factors. As we mentioned and talked about it earlier, the tariff is a big factor, right? And oftentimes, a lot of these critical minerals and metals don't come from every single countries out there. So it's a really big part of the trade, global trade. If you think about a lot of these regions, they tend to be politically sensitive regions, which can affect the production and investment of underlying. And then demand is also very sensitive, but also, again, where the demands are is not every country has the same different type of demand. So really thinking through where the production regions are, what are the demand regions are, and then what are the geopolitical factors that goes into that, which I think also makes these things a lot more complicated, but also very interesting investment. The third is environmental regulations. As the world moves towards sustainability, energy transition economy, ESG factors are important. However, based on the region, right? There is a emphasis and de-emphasis right now that are going on, but directionally that's where we're headed. So I think in general, it's very important demand for a lot of these critical minerals and metals, especially in the long run. But because of a lot of the other factors that we talked about, I think that there will be a lot of fluctuation in between. So really thinking through what are the commodity fluctuation that I'm looking to get? What are the geopolitical aspects of it in supply and demand of this specific underlying? And what are the environmental factors are and what are the durations that I'm willing to invest in these underlying commodities? I think those are one of the key factors you should really consider before investing.
All of those right now are really culminating in the form of financial market news and commentary. I think obviously everybody knows what tariffs are doing in terms of consumer sentiment. People are really not sure what the headlines are going to look like the next day. They're not really sure what color they're going to see when it comes to the markets the next day. But with current market news of tariffs, what are some things that you think people should keep in mind in the coming months? Because as you and I had discussed previous to this call, just briefly brainstorming, new manufacturing cannot spring up overnight. The US isn't really known for having all pieces of their manufacturing line in terms of the metals that they're producing and also the metals that are used in producing other things and other machines. What are some things that you think listeners should keep an eye out for or take into consideration in the coming months?
Yeah, I think those are really good questions. So I think one thing for sure is uncertainty. I think uncertainty is really here to stay. And again, I think it's really about the duration of investment that you're thinking through. I think a lot of these critical minerals and metals in general has a very positive long-term outlook just because in general we're going to be needing more of these metals to build infrastructures and other things as we move more towards energy transition economy, and that's a fact, right? For example, right now, in the United States, 4% of electricity is being used for powering the AI generative related items. Now in 2030 that is expected to grow 10% of the overall US electricity. So how are we thinking about powering these in sort of this new economy? And if you're thinking about that, how are we store these powers? How do we transport these powers? So for example, that is battery, right? Or cables and other things. For example, copper, aluminum, other things are going to play a very critical role in these. So demand is here to stay in terms of a longer term, and if anything, it's going to continue to grow. However, how these trade policies going to work out, what is tariff going to play the role in every aspects of metals are going to be different based on what you're talking about. Not many companies are going to just invest based on next 3.5 years. They need to have assurance on a longer term. Having said that, there are also a lot of mines out there in the United States and juniors, as we talked about earlier, that are ready to go and it's been working for past 14, 15 years that are waiting for permits as well. So there are some of those miners that are operationally be ready in next year to get it off the ground. Some of the manufacturing could get to the production in next 2 to 3 under 3 years time frames. Certainly things are that are out there that are a possibility. But again, I think in general, as a corporate, commercially driven firm, you're not going to make a decision just based on 1 to 2 years outlook. You're going to make a decision on a more of a longer term. So having some more stability around policies, understanding around that would be really critical for companies in general to make a investment because these are not a small investments.
I couldn't agree more. I think that's an excellent point to talk about it from the corporate perspective of how you're going to look at your growth outlook, how you're going to look at your company's roadmap for the next decade, per se. Are you going to start shifting your manufacturing from bringing together several pieces from other places to now having to do everything domestically or potentially in house for some elements? Realistically, a lot of the semiconductor area, which is another podcast we have coming up, that job line and that manufacturing line, if you will, it had a lot of influence in it from the Pacific areas
Yep.
and Asia, and that workforce was deriving its value from a specific dollar amount that now if you brought it back to United States shores, do you even have the workforce prepared for it? Do we have the metals prepared for it? All of those elements. It's a really good point. That kind of leads me to my next question. I know you were at a conference recently. Were there any new trends or interesting topics or notes on market fluctuations that you found interesting or something that you're going to be looking to in the future?
Sure. I was recently in Singapore last week for Cobalt Congress, which is really the cobalt driven sort of industry gathering, and then IWCC International Raw Copper Council, which is really focused around the copper. The common theme again is a long-term outlook and demand is looking strong, especially around copper. But ESG was definitely a topic in terms of how do you make things more sustainable? How do you think about the environmental controls around this? So that was another kind of a big factor. But to your point earlier about the semiconductors and other things, is that I think where US will play a good role is I think we're past like a very much of a heavy manufacturing, but we're talking about more value add manufacturing because one of the conversations that we've heard a lot about potentially moving production to the US is that we don't have workforce. Even if they built a plant somewhere in the United States, do we have enough of workforce that are willing to work in these factories and whatnot? So I think one of the things that were brought up is that yes, US manufacturing could happen, but it would have to be more of that high value semiconducting type of businesses. And they were certainly talking about the reshoring aspects of it because given that I would say 60, 70+ % of the semiconducting businesses right now is out of China. So how do you align some of those things more safely through maybe Korea or Japan and then partnership with some of the more geopolitically friendly regions and then bring those investment into the United States. So certainly I think it's going to be a very interesting next 2 to 3 years to see how all these things pan out. But before that, we got to solve the tariff issues first. Because right now there's just a lot of volatility due to the uncertainties around tariffs. So we got to figure that portion out. So I would say the conversation was really around supply and demand, the tariff in the US and what does all this means, and then reshoring of some of these supply chains moving forward and possibilities around that.
There's definitely going to be some reshuffling. And as you said, we don't really know how this story ends. It's about a 2 to 3 year long adventure for all of us. So we're not totally sure. But thanks for joining us today, Jen. You brought up some great points.
Thank you. Thanks for having me, Cassidy.
Sure, of course. As always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to give us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Mutual funds are investments that pool the funds of investors to purchase a range of securities to meet specified objectives, such as growth, income, or both. Investors are reminded to consider the various objectives, fees, and other risks associated with investing in mutual funds. IBKR does not solicit you to invest in specific funds and does not recommend specific funds or any other products to you. For additional information, please view our mutual fund product listings. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. U.S. spot gold trading through IB LLC accounts is only available to legal residents of the United States that do not reside in Arizona, Montana, New Hampshire, and Rhode Island.